and welcome back to our weekly Market Insight series. It's brought to you by the Capital Markets Trading Desk here at SunWest Mortgage Company. Let's get into it. Now, look, the government has reopened, as you know. So without any further ado, let's get to the latest news. Treasuries moved higher over the week while equities rebounded from several days of losses, helped by renewed confidence in the AI trade, which has been a major driver of the current bull market. Earlier concerns about stretched valuation in AI-related stocks eased as stronger earnings and guidance from several large-cap names reassured investors. Market participants also digested a wave of delayed economic reports following the recently ended government shutdown, which lasted more than 3 weeks and held up several federal data releases. The minutes from the Federal Open Market Committee's September meeting, released on Wednesday, showed a clear divide among policymakers over the committee's decision to cut rates at that gathering. Several officials expressed concern that inflation remained too elevated to justify additional easing, while others viewed signs of slowing labor market momentum as a greater risk to the outlook. The minutes also included uncertainty about the path for the rest of the year, with many participants suggesting it would likely be appropriate to keep rates steady through the remainder of 2025 while continuing to monitor economic conditions. In housing finance, MBA mortgage applications declined 5.2% for the week ending November 14th. Mortgage rates climbed for the third consecutive week to 6.37%. Contributing to a 7% drop in refinancing activity and a 2% decline in purchase applications compared with the prior week. However, refinance activity was up 125% and purchase applications increased by 26% from the same week last year. Home builder sentiment showed only a slight improvement in November as elevated mortgage rates and general economic uncertainty continued to weigh on demand. The NAHB Wells Fargo Housing Market Index rose to 38 from 37 in October, but remained well below the 46 recorded a year earlier. Builders continue to rely heavily on incentives to attract buyers. 41% reported cutting prices, the highest share in the post-pandemic period, while 65% used sales incentives unchanged from the prior 2 months. Sales of previously owned homes reached an 8-month high in October. According to the National Association of Realtors, contract closings increased 1.2% to an annualized rate of 4.1 million, following an upwardly revised 1.3% gain in September. Sales were 1.7% higher than a year earlier. The median existing home price rose 2.1% year over year to a $415,200. The improvement in sales largely reflected a decline in mortgage rates earlier in the fall. Housing inventory fell 0.7% from September to 1.5 million units, though supply remains nearly 11% higher than a year ago. Labor market data that had been delayed by the shutdown was released Thursday and presented a mixed picture. Non-farm payrolls increased by 119,000 in September, rebounding from the 4,000 jobs lost the previous month. The unemployment rate edged up to 4.4%, the highest since October 2021, suggesting softer labor force conditions despite the pickup in hiring. Average hourly earnings rose 0.2% during the month and 3.8% from a year earlier. Initial jobless claims fell by 8,000 to 220,000 last week, indicating that firms remain reluctant to get rid of their workers. Though continuing job claims climbed by 28,000 to their highest level since late 2021. The U.S. trade deficit narrowed sharply in August as delayed Commerce Department data was finally released. The deficit shrank 24% to $59.55 billion from a revised $78.15 billion in July. Imports fell 5.1%, reflecting softer domestic demand and the earlier effects of recently implemented tariffs, while exports rose 0.1%. The data had originally been scheduled for publication in early October, but was postponed due to the shutdown. A separate Commerce Department release showed that new orders for U.S. manufactured goods rebounded in August. Factory orders rose 1.4%, reversing July's 1.3% decline and matching economists' expectations. Orders were up 3.3% from a year earlier. Durable goods orders increased 2.9% after July's steep 9.3% drop, while non-durable goods orders slipped 0.1%, following a 0.9% gain in the prior month. Now, you cannot tell me this doesn't wrap up this week's news with a big red bow. Okay, so if this video is informative and you want to stay updated on current market news, please hit that like button. It is a free way to support the channel and lets us know you like content like this. Please share and subscribe. Also, go ahead and tap that notification bell so you are alerted when a new Buffy video is uploaded. Yes, thank you so much. Have an amazing weekend on purpose. Buffy out.